Hi everybody, this is Gary Dean with Sentiment Timing, and this is our technical video report for Tuesday, January 16th, 2024. So we saw the S&P. We did see some selling today, but as you can see in this blue really line right here, there's really two patterns that I'm following, and they're not really giving us too much information, meaning that we could go either way. But the first one, this is it's what I'm looking at as a megaphone top. So you can see we came up to the top, came down, came up, and we've been following it where it's making lower lows and higher highs. And it drives people crazy because what happens is once we take out these lows here, everybody jumps in because we made a lower low, and then they shoot up. And then once we take out these highs, everybody gets stopped out and everybody gets bullish, and then we come back down again. So if it's going to follow that pattern, that is suggesting that we're going to have a move somewhere up into the 48.30 level. That's just coming to the top of it. And it's hard to say exactly where because this is moving up this line. But now we also have this bear flag that's in you can see we're also playing ping pong on, where we came up, down, up, and now we hit it again. And if this is going to play out and we're going to head up to the top, we're going to be looking at a move somewhere around the 48.09 level. But this pattern right here is suggesting that we're going to break to the downside, meaning that bear flags mean down, bull flags mean up. So this is again, we have two kind of conflicting patterns where if we do head up to the top of this and then stretch out, then it brings in the bearish pattern with the megaphone top. And if we come up there and then take out these lows, then we'll be looking to come down somewhere at the bottom of this, which will probably be right around the 4,600, depending on when it gets there, because again, it's going to be coming from up these levels. So those are ones. You can see we really didn't have any bullish divergences today, but once we hit the bottom of this channel, buyers stepped in. I believe the S&P was down as much as like 30 points at some point, and then we rallied back towards the end. So they went below the 200-day moving average on the 15, but bounced right back up like we've been seeing. And now we're at a pivot point where if the bulls can break above this, now they're back above the 50-day, and then we start looking at the 47.82 as resistance, 47.90, and then obviously up at the 48.03. Above this, that's where we start looking at the previous all-time highs. That's going to be up right around that the 48.18. So those are really our upside targets, and I do believe the bulls are going to have some problems, being able to just drive price higher because. Honestly, I think they're starting to run out of buyers, meaning that people aren't really all giddy about jumping into this market right now, just because of honestly the way that they've done it, where the all you can eat diner move came in, and now we're consolidating a little bit, but everybody's just anticipating higher. So right now I think they're just at a point where people aren't really believing that the economy is anywhere near where the market is. And a lot of times it's not like that, but the market just got way ahead of itself and them, really anticipating 6 rate cuts. And that's what the perfection is being really painted into this market right now, is everything's going to be all hunky-dory because the Fed's going to stop cutting rates or stop raising rates and maybe cut 3 times, but they're anticipating 6 times. So they're definitely ahead of themselves. It just doesn't mean that the market has to turn right now. But the intermediate term charts that I've been showing in the premium report, one is that we have that NIAID sell signal. So if that doesn't get fixed, then that typically does anywhere from 100 to 300 points on the S&P. I really use it more for a topping pattern than I do a bottom. But in any case, we have that. Then we have, that extreme put call ratio that was, coming into the end of December when it was at extreme levels. And that's typically anywhere from a 2 to a 400 point drop. And then just stocks above the 50-day moving average where, they hit levels where, again, we see moves on the downside anywhere from 2 to 400 points. So there's intermediate term, reading readings out there that are dangerous, especially when you're looking at the sell signals on the daily chart. So right now, really, the best way to look at this is if you assume that we're going to come back up here, if it's going to follow it. Now, if this gets taken out, we do have this support over at the 47.38 level. So we have that, and then from there we start going down to the 46.82. But this is some, pretty strong support right between the, the 46.40 and the 46.30. So that's what they're going to have to get through. Below that, that's when we start looking at the 46.50 in that range there. Now, if the bulls get above it again, I pointed out the resistance. If the bears push it back below these lows, we just keep an eye on this support level. If that's taken out, then I'm anticipating that we're coming down somewhere into the 4600, 4650. But as I've been, really showing you in the premium reports, is that we have, a lot of open gaps in. For health reasons for the market, if it wants to stay sustained on this, I would expect a move down to the 44.21. That's pretty much where I would be comfortable looking to buy, because right now they've thrown everything in and they're anticipating perfection, even when the Fed is telling them that they're only looking to cut 3 times, but the street is counting in 6 times. So let's see what plays out tomorrow. The 2 patterns that I showed you, that's what we really need to keep an eye on. Hopefully we'll get an answer before the market opens tomorrow. And with that, let's see what plays out in the morning, and I'll talk to you guys in the morning.